Are you ready to unravel today's stock market chaos? The Fed held steady while ongoing concerns about tariff policies continue to drive volatility. The tech sector continues its focus on NVIDIA's GTC, while a sell-off on their stock took place as China announced DeepSeek's AI requires fewer of NVIDIA's processors. We'll get into all of that, plus check out how our strategic test funds held up and snag today's game-changing tip to sidestep the hidden risks that could be impacting your investments. Tune in to stay ahead. Hey, since you'll forget at the end, just go ahead and like the video now. The market was up today. The S&P 500 was up 1.08%. The Dow was up 0.92%. The NASDAQ Composite was up 1.41%. And the New York Stock Exchange was up 0.82%. Getting into some of today's top news events, Federal Reserve policy decision came in, so the Fed meeting concluded today with a reaffirming of the prior policies. There was no change today indicated, and the anticipated decreases later this year are still on the table. So no news ended up being good news for the stock market this afternoon. Trade policy and tariff uncertainty, so ongoing concerns about President Trump's trade policies continue to drive volatility. The uncertainty is weighing on investors, contributing to a broader pullback in growth stocks. The potential for retaliatory tariffs add further complexity, and all of this is impacting economic growth forecasts. In terms of NVIDIA's GTC conference, investors are watching for updates on AI industry trends and the new Vera Rubin GPU, especially after a volatile recent period for NVIDIA's stock, which was triggered by an announcement that DeepSeek AI, the model leveraged by China, requires fewer NVIDIA chips. So as the event progresses, AI-related stocks remain a focal point amid some shifting market leadership. Now, these events are set against a backdrop of mixed economic signals. Recent data shows slower GDP growth, persistent inflation concerns, and a market digesting high valuations from high levels of growth over the last 2 years. All right, taking a look at our portfolio for today, we were up just shy of 2.5% to the market, or S&P 500's return of 1.08%. So, of course, that's what we like to see. We like to outperform the market. But, you can tell that the beta of our portfolio is a little bit bigger than what the S&P 500 is because we're experiencing returns that are a little bit larger, a little bit larger losses and a little bit bigger gains. However, we'll take it, absolutely any day that you're going to gain 2.5% with your portfolio is a pretty good day. In terms of some of the largest earners out there for us today, Caesars Entertainment came in with a 5.6% return. Tesla recovered a little bit today with a 4.6% return. As well, we had MNSO Group with another 3.7% return. As well, Palantir came up about another 2.6%. So pretty much green across the board. Valco Energy did go down a little bit more than a point for us today. But overall, a green day here, and pretty happy so far with the overall strategy of the portfolio and how things are performing. I have mentioned a couple times now that the variability is a little bit higher, probably the beta for the portfolios, maybe a little bit more than I would care for, but the returns that we're seeing have been pretty consistently in the positive. So I'm up for the most part, stick around and continue to rep this portfolio, at least for the next few weeks. But I'm going to continue to come in here every single day and provide you with updates. And certainly if there's something worth mentioning, I'll bring it up. And I think a few weeks ago, I did a little bit of a segment where I introduced you to some of the companies that we decided to invest in. And then we rebalanced last week, and I haven't taken the time to actually bring in and talk about some of those new investments like I mentioned, Caesars Entertainment today. So I don't know if it'll be this week or early next week, but I'm going to definitely do some of those headquarter videos so you can get a little bit more insights into the assets that are in my portfolio. And if you like videos like that with company headquarters in it, be sure to check out our YouTube channel. We try to post a new video about every week or two that is an industry or market top 10, where we cover the top 10 or 15 companies based on market cap for a particular industry. And we show you a shot of their company headquarters, talk about a few different facts of the company, and then give you a little bit more insights into those industries and investments. So certainly something to check out if you haven't already. This week's top performing strategy is still Trainer's Measure, although Sharpe's Measure is creeping in there a little bit more today. The one aspect that's standing out to me is that nearly all of these portfolios are leveraging short-term returns, like 90 days or 1 year. Now, the numbers shown here are week to date, so if you're up more than 4% this week, you've got our test funds beat. You'll have to come back tomorrow to see if Trainer's Measure remains on top or if Sharpe's Measure ends up taking over. Now, something tells me with the news from the Fed today that we'll likely see more Sharpe's Measure-based portfolios on here tomorrow. Today, for our strategy recap, we're discussing Sharpe's Measure. Now, Sharpe's Measure is one of two metrics we leverage that uses a risk-free rate and calculates a risk premium. Now, if you don't know, the risk premium is the expected return of the market less the risk-free rate. So in theory, if there's a return on a 1-month treasury, and that's guaranteed, say it's 4%, then you should not accept a return from your investments that's anything less than 4%. In fact, since you're taking on risk by choosing to own the stock instead of that guaranteed treasury, you should be paid a premium for that. Now, when you calculate the risk premium, it should always be positive. If it's negative, you shouldn't even consider the stock. That's because you can earn a better return with assets that have little to no risk, so why bother with that stock? Now, I know some of you will ignore the statistics and still make that investment, but just know that the math is against you, and if the math is against you, so will be the trading algorithms on Wall Street. Now, getting back to Sharpe's Measure, because you're dividing the risk premium or the premium that you're getting for holding on to that stock by the stock standard deviation, or how much the stock varies each day, what you end up with is referred to as the reward to volatility ratio, which is a fancy way of saying how much return you're getting for each unit of risk you're taking on. Now, knowing that, hopefully now you can understand why this is most investors' favorite metric. And with our testing, it seems to be best to use Sharpe's Measure for selecting assets during times of consistent growth, or when investors are looking for a stock-based safe haven. For last week, Sharpe's Measure was green, although on average, its returns were a little bit lower than some of the other metrics. In terms of assets, portfolios with 5 assets performed the best. From a return history standpoint, like we saw in this week's top performers, last week the portfolios with short-term returns, or in this case 1 year, produced the best returns. So if you're looking for the best performing Sharpe's portfolio from last week, it was the portfolio with 30 assets and 1 year of history, although there were still several portfolios that had 5 assets in them that had similar returns. Now, in general, I love using Sharpe's Measure for stock selection, and typically the stocks with the highest rankings are companies that you're already familiar with and have been hearing about for years already. Today's tip is all about portfolio grades. Now, when you're pairing your assets together, most finance folks will leverage what's called a covariance matrix to find out how much risk each asset is contributing to their portfolio. However, for folks without that finance background, many don't do this or even know what I'm referring to right now. All I'm saying is rather than reference a number to quantify how much risk each asset is contributing to your portfolio, we take those same principles and leverage our grading scale from our asset grades to come up with another comparison that just helps you see where the risk is in your portfolio. Now, keep in mind that in working with a portfolio grade, A isn't always what you're striving for. You just want to use these as a point of reference to better understand if your risk is diversified or if you have a few assets in there that are forcing you to take on more risk than you really need to. Now, these can be handy when you have a number of stocks you're considering and you don't know which ones to pick. For example, you may want to include a hotel stock in your portfolio, but as you go to add the company you wanted to invest in, you might find out that it doesn't interact well with the investments that you already have. Now, leveraging these grades allows you to quickly try a few other similar companies to find the one that's going to work best with the other assets that you already own. Now, bottom line being that when it comes to mitigating risk, you might love some investments, but it doesn't mean they'll love you back. Well, that's it for today's episode. I hope you're enjoying the new format as I transition this from a daily portfolio update to a full-on daily market recap. I will absolutely still be providing daily updates to my portfolio, but to make this more interesting, I just wanted to structure this a little bit more and add some more sections where you can gain more insights. Now, as always, I appreciate you being here, and until next time, I'm Matt Franklin. Have a great night, and I'll see you all back here tomorrow. Hey, just a friendly reminder to do something below the video.